Options give traders more flexibility and control over the combination of risk, time, and money management than just owning shares of stock. They also give traders much more leverage, which translates to potentially larger profits in comparison to just owning stock shares. There are other benefits to buying and selling options, such as hedging, where you can use different strategies to offset a losing position or potential future loss. Options at first appear very complex and difficult to understand. But once you understand the basics of how they work, you'll begin to understand that not only can you make money with their basic simple structure, you can also make money employing a wide range of strategies using those same basic structures. These strategies can increase risk, increase return, decrease risk, decrease return, and everything in between. In this video, I'll introduce you to the basics of call and put contracts before moving on to 4 basic option strategies involving calls and puts. Then, I'll show the trading method used in this series for buying and selling calls and puts based on the inferred future direction of a stock using stock charts and the option chain. Many stocks in the market allow options to be traded on them. You can do a search for stocks that may interest you by using a free stock screener. You can choose which criteria to filter the stocks in the results list. Then you can use your favorite charting service to view the option chain that will display the options associated with the stock you choose. The following is a quick checklist of terms to remember for option trading. Call option, put option, strike price, Greeks, expiration, buying and selling contracts, writing contracts, underlying. Call option. A call option contract will increase in value when the underlying stock that it represents increases in price. The value of the call will decrease in value when the underlying stock decreases in price. Put option. A put option contract will increase in value when the underlying stock that it represents decreases in price. The value of the put will decrease in value when the underlying stock increases in price. So calls and puts work opposite each other. Strike price. The strike price is usually difficult for the beginner to understand as being separate from the option contract value. This strike price does not change in value. Rather, the underlying stock price changes in relation to the strike price and in turn changes the value of the calls and puts. You can see that for every strike price in the vertical list in the middle of an option chain, that there is a call on the left and a put on the right. As the underlying stock price rises to and past the strike price, the calls on the left become worth more the farther the underlying price keeps rising. While the price is rising, the value of the puts on the right side keep falling. As the underlying price starts to come down, the put values will become worth more and the calls worth less. Remember, calls and puts work opposite each other. The more valuable a call or put becomes is how far in the money it becomes, with the underlying stock's price moving in favor or against this strike price of the calls and puts. Greeks. These refer to the different items that make up the value of an option contract. The 3 most important are delta, vega, and theta. The rate at which the value of a call or put contract changes is the delta. Delta is how much the value of the contract increases or decreases for every 1 point or $1 change in the underlying stock's price. If a call option's delta is 0.50, then the value of the call contract will increase approximately $50 if the underlying stock's price rises $1. If you buy more than one contract, you would multiply the delta by the number of contracts for the potential profit amount. For example, 5 contracts times 0.50 delta equals 5 contracts times $50, which is $250 for every $1 increase in the underlying. For calls, the delta is shown as a positive number, and for puts, the delta is shown as a negative number. The calculation is still true for both calls and puts, however. Vega refers to the volatility of the underlying stock, which is used in determining the value of an option contract. You can watch implied volatility with the IV rank or IV percentile studies on the stock chart to see where it currently resides. Over 50% is considered a better market suited for writing option contracts, and under 50% is considered a better market for buying option contracts. Theta refers to time decay. Every option contract is losing value over time, more so the closer it gets to expiration, and especially with less than 20 days left until expiration. Therefore, it is ideal to write option contracts with less than 20 days left until expiration and buy option contracts with preferably more days until expiration, usually at least 40 days or more. Expiration. Each option contract is set to expire on a specific date, generally the third Friday of every month. You will either hold until expiration or sell before expiration an option contract you own, depending on your strategy. In this series, we buy contracts and then sell the contracts we own before expiration. Buying and selling contracts. This is the method used in this series. You initiate this setup by buying an option contract, either a call and or a put, holding it for a length of time, and then selling it, or letting it expire. Writing contracts. This method is initiated by selling a contract first, collecting a premium, which is the value of the contract, then buying the contract back later or letting it expire. This method usually requires that you own the 100 shares of the underlying or have enough cash in your trading account to cover the cost of the 100 shares, unless you are a professional trader. Underlying. Remember that every option contract is associated with a stock that you have researched to be a good candidate for buying or selling option contracts on. So, for example, you have researched Google and decided to buy calls. Google's stock is referred to as the underlying to any option contract that is bought or sold pertaining to Google. This is what the term underlying means. So as an example, a Google call option represents 100 shares of the underlying Google stock, or a Ford put option represents 100 shares of the underlying Ford stock. One question that needs to be answered before going any further that is possibly asked more than any other question pertaining to options is, how do you make money with options? Profit obtained from option contract transactions happens a few different ways. One way is to buy a call option at market value or current value and then sell it once its value increases. It will increase in value because the stock that the call option is associated with will rise in price. When you buy a call option contract, you would say that you have a long call. Another way is to buy a put option at market value or current value and then sell it once its value increases. It will increase in value when the stock that the put option is associated with falls in price. When you buy a put option contract, you would say that you have a long put. Another way to make a profit is by the difference in the value of two things, one being the strike price of the option contract and the other being the share price of the option's underlying stock. This might require you to own 100 shares of the underlying stock since each option contract by default represents 100 shares. Remember, the strike price of each contract does not change. The underlying stock's price does change. And because the option contract represents 100 shares of the underlying stock, the strike price also refers to those 100 shares the option contract represents. And any difference between the strike price and underlying price can be a profit or loss depending on the underlying stock price change in relation to the strike price of the option contract. For example, you may be able to purchase the 100 shares at a discount, or you may be able to sell the 100 shares at a greater profit. Yet another way to profit from options is to write a call or put option, which simply means to first sell the call or put option before buying it back later or letting it expire. It is the opposite of first buying the contract, then selling it later once a profit has been reached. Writing contracts may also require you to own 100 shares of the underlying stock. The last way to make money from options is any combination of the previously mentioned in what is known as a long list of option trading strategies, each having their own benefits and drawbacks. Feel free to research the many option strategies available to see if any other strategy fits your own personal trading style. You may find that you like writing put option contracts for a monthly income versus buying and selling call and put contracts. No matter what strategy you decide to use with options, you will still want to use studies, trends, patterns, and other chart tools for determining which direction the underlying stock is going or likely to go. The value of an option contract, whether it be a call or put, rises and falls depending on several things. Two of the most important are the underlying stock's price and implied volatility. These are two things to consider when buying a call or put. Every call option contract and every put option contract represents 100 shares of an underlying stock. You may or may not have to own these shares of the underlying stock depending on how you intend to use options. If you are following the trading method in this series of buying calls and puts, you really don't need to own the shares if you intend to purchase and then sell the call or put based on the contract's value. Here you are just trading the value of the options contract the same as if you were to buy and sell a stock share. Alternatively, you may be required to own the 100 shares of the underlying stock in other option trading strategies for various reasons. The four basic option strategies are the long call, in which you buy a call option contract. The short call, in which you write a call option contract. The long put, in which you buy a put option contract. The short put, in which you write a put option contract. An example of a long call, that is to buy a call, is to first determine that the underlying stock price is uptrending on a daily chart. You will look for pullbacks to support areas in the uptrending price direction, then make the call purchase. The call will increase in value when the underlying stock price continues to rise until at some point the price will find resistance. It is at this point that you should sell the call you own for profit. You can use the studies previously talked about in addition to the hourly chart to make buying and selling decisions. Things to remember when buying calls. Don't hold until expiration unless this is part of your strategy. Don't hold a call with less than 20 days left until expiration. Consider buying calls when implied volatility is below 50%, and consider only buying calls in an uptrend. An example of a short call, that is to write a call or initially sell a call, is first to determine that the underlying stock price is downtrending. This is because you are collecting money from the buyer that you sell the call to, which means that you want the call to expire worthless for the buyer so that you can keep the entire amount collected. The money you receive from the sale is called the premium, which is the value of the option contract. Remember, if you write a call, you want the underlying stock price to do the opposite of a long call and fall rather than rise. Things to remember for call writing. You most likely want to sell a call when implied volatility is higher than 50% and less than 30 days left until expiration. Also, you can hold the short call position until expiration or buy the call back before expiration. Consider only writing calls in a downtrend. With this method, unless you are an expert, you could be forced to own the 100 shares of the underlying stock, which is called a covered call. An example of a long put, that is to buy a put, is to first determine that the underlying stock price is downtrending. You will look for price advances to resistance areas in the downtrending price direction, then make the put purchase. The put will increase in value when the underlying stock price continues to fall until at some point the price will again find support. It is at this point that you should sell the put you own for profit. Things to remember when buying puts. Don't hold until expiration unless this is part of your strategy. Don't hold a put with less than 20 days left until expiration. Buy a put when implied volatility is below 50%. Consider only buying in a downtrend. An example of a short put, that is to write a put or initially sell a put, is to first determine that the underlying stock price is uptrending. This is because you are collecting money from the buyer that you sell the put to, which means that you want the put to expire worthless for the buyer so that you keep the entire amount collected. The money you receive from the sale is called the premium, which is the value of the option contract. Remember, if you write a put, you want the underlying stock price to do the opposite of a long put and rise rather than fall. Things to remember when writing puts. You most likely want to sell a put when implied volatility is higher than 50% and less than 30 days left until expiration. Also, you can hold the short put position until expiration or buy the put back before expiration. Consider only writing puts in an uptrend. With this method, you would not necessarily have to own 100 shares of stock because you can have enough cash in your trading account to cover your sold put, which is called a cash secured put. Before we ever choose an option contract, we have to use charts for our choice of direction to play. The following is a brief overview of how we trade options, followed shortly with a more detailed visual walkthrough. This method is for buying and selling calls and puts for profit and is not for writing calls and puts to collect a premium. We will use the stock ticker fold for this first example with an emphasis on buying calls with over 50 days until expiration and only holding short term, maximum 5 days in an overall positive market environment. You can use shorter expiration dates for trading contracts after you gain enough experience. Keep in mind that time decay erodes the value of option contracts more the shorter you go with expirations. First, we look at the overall general market and what direction it is moving. We use the S&P 500 with the weekly chart. Use MACD histogram with the price candlesticks to determine overall direction. This is considered the strength of any new trends because of the longer time frame. Look for MACD histogram bars that are dark red coming up from a light red bottom area, signaling a potential overall upward movement that might provide sequential price pullbacks and advances for buying and selling on the daily chart. We then look at Fold's weekly chart to determine its strength. Use MACD histogram with the price candlesticks to determine overall direction. Now refer to the daily chart for the past year. Use the Bollinger Bands, the 10-day, 20-day, and 50-day simple moving average, MACD histogram, stochastics, and channels to pinpoint a breakout uptrend from a ranging area or an area that is ready to start trending upward from the bottom channel line. Try to determine good entry and exit points before your purchase by drawing support and resistance lines across the chart. After studying the daily chart and finding a buy area, we buy a call option contract or several call contracts on Fold while using no more than 25% of our total trading capital. For example, if our total trading capital is $5,000, 25% of that leaves us with $1,250 to trade with. If the option contracts value are $1.30 or $130, then we would divide 1,250 by 130 to determine how many contracts we could buy at one time. 1,250 divided by 130 is 9.61, so we would be able to buy 9 contracts. Or we could buy 4 contracts and leave enough money to buy an opposing position to hedge against a potential loss if our first option purchases start to move against us. This is an example of the leverage that trading option contracts allows us to have versus trading shares of stock. Let me give you another more thorough example of this leverage in the following comparison. So you decide to use 25% of your total capital. 5,000 times 0.25 equals $1,250 to buy shares of the stock Fold at $6 a share. This would cost you $1,248 for 208 shares. And if Fold rose $1 to $7 a share and you sold the 208 shares, your profit would be $1,456 minus $1,248, which equals $208. Now again, instead of buying stock shares, you take advantage of options and you decide that through charting analysis and using your studies that Fold looks like it will advance upward at least $1 from $6 to $7 over the next 5 days. And you decide to buy call contracts with volatility being below 50%. You see that the calls that you are interested in expire 72 days from now and they will cost you $130 a piece. If your total trading capital is $5,000, then you divide your 25% of that, which is $1,250 by 130 equals 9.61, and see that you can buy 9 calls which will cost $1,170. The delta of these calls are currently at 0.73, which means that for every $1 raise in the underlying fold stock shares that each call, remember there are 9 that you are purchasing, will raise approximately $73. So if you buy the 9 calls and the underlying stock fold rises from 6 to 7 or $1, then the calculation would be 9 calls times 73 delta, which is $657. So in comparison, you make more with less. You can either buy $1,248 worth of stock shares to make a profit of only $208 with a $1 rise in stock price, or you can buy 9 calls for $1,170 to make a profit of $657 with a $1 rise in stock price. This again is the leverage advantage of buying and selling options. There is even more leverage that can be utilized when using other option strategies while owning 100 shares of the underlying stock. Please search for option strategies and research them to find what these are. So let's do a more thorough walkthrough of the method used in this series with the information just talked about. First, we look at the weekly charts on the S&P 500 to check the overall market action. Is it bullish or is it bearish? Look at the MACD histogram. So we determine that we want to buy calls because it looks as if the market is positive with news and is going to head higher in an uptrend. We now use a stock screener to search for stocks that might interest us in an uptrending bullish market. We will use some basic criteria to narrow down the selection of stocks to a few to look at. Let's screen with optionable equals yes, country equals USA, pattern equals channel up, average volume equals over 500,000, price equals greater than 10, less than 20, analyst recommendation equals strong buy, sales growth past 5 years equals positive. After we have narrowed down some stocks to check out, we study the charts of those stocks to see if the price action looks stable, and we are able to define a nice uptrending channel. A stable price action means that there are easily identifiable up and down price fluctuations for many days that can be drawn in a channel. Also, we'd like to see few ranging areas where the stock's price is going more sideways or horizontal on the chart. After finding a good candidate, we decide to check the weekly chart with the MACD histogram and look at the weekly direction for the past 2 or 3 weeks. Then we need to run the stock through the checklist of studies on the daily chart to look for buying and selling areas. We start by drawing support and resistance lines, comparing price location and direction to the Bollinger Bands, comparing price location and direction to the moving averages, and looking at MACD histogram stochastics and volume. Don't forget to look for ranging areas where a trend direction may develop. We also check the IV rank and that it is below 50%, preferably. We use all of this information in addition to support and resistance lines to determine a buy point and a possible sell point for the call contract or contracts. Note that we also are looking for continuing positive news in both the general market and the stock we are interested in while we are buying calls. At this point, we check out the option chain and look for a call that is at the money, or more specifically, has a strike price close to the underlying's BZH current stock price. We take note of the current market value, open interest, spread, and delta of the call option. We like the current market value of 97. The open interest is 120, which is above 100. The spread is 5%, which is less than 10%. We note how many calls we can buy and decide to buy half of our 25% capital allowance. So if our total capital is 5,000, we are going to use half of 25%, which is 12%. That is 5,000 times 0.12 equals $600. Now we are buying 6 call contracts with maximum $600 with the intention of later selling those 6 calls at a profit. $600 divided by $97 equals 6.18. So we are able to buy 6 calls with $582. So we match the call purchase with the timing of the stock price on the daily stock chart. Again, this is to buy the call when there is a dip in stock price in an uptrend. The call's value is currently at $97. Here we purchase 6 calls at this price. We will hold the calls until a daily price candlestick starts to close lower than the previous day's closing price and below the top Bollinger Band. It is at this point we sell the 6 calls that we own. The value of these calls will then be worth $267. So our profit for these call option contracts is sale price. 6 calls times $267 equals $1,602. Purchase price. 6 calls times $97 equals $582. $1,602 minus $582 equals $1,020. Profit in 7 days. Buying a put contract or contracts would be the same, but we would be in a downtrend, both with the general market and the individual stock that we are interested in buying options with. We are looking for put buying opportunities on the daily chart when price advances upward in a downtrend, and we are looking to sell the puts we bought when the stock price declines, continuing its downtrend. Whether we are using uptrends or downtrends, or buying calls or buying puts, the thing to keep in mind is that we need to use support and resistance to time our buying and selling.